Ladies and gentlemen, good day and welcome to the Q1FY24 earnings conference call of Shopperstop Limited, hosted by Perfect Relations. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Mamta Samat from Perfect Relations. Thank you, and over to you, Ms. Mamta.
Thank you, Michelle. Good morning, and thank you all for joining us on the Shopperstop Q1FY24 earnings conference call. Today we have with us the senior management represented by Mr. Venu Nair, Customer Care Associate, Managing Director and Chief Executive Officer, Mr. Karunakaran Mohanasundaram, Customer Care Associate, Chief Financial Officer, and Mr. Jay Prakash Maheshwari, Customer Care Associate, Vice President of Finance and Accounts. We will begin the call with the opening remarks from the management, after which we will have the forum open for the interactive Q&A session. I must remind you that the discussion in today's earnings call may include certain forward-looking statements and must be viewed, therefore, in conjunction with the risk that the company faces. Please restrict your questions to the quarter and yearly performance and to the strategic questions only. Housekeeping questions can be dealt with separately with the IR team. I would now request Mr. Venu Nair for the opening remarks. Thank you, and over to you, sir.
Thank you, Mamta and Michelle, and good morning, friends. Thanks for joining us today to discuss the Shopperstop financial results for the first quarter of FY24. Along with me, I have Karuna, our CFO, and Jay Prakash, our FP&A lead. I will begin with the retail market as on date and then cover our quarterly performance in detail. As has been extensively reported over the last few months, the retail market, particularly apparel, has been moderating since Diwali of last year. In the light of that, we had a mixed quarter with strong growth in beauty, non-apparels such as luggage, watches, etc., with a lower growth in apparel. Last year, the same quarter, as you are aware, we had the pent-up demand post-COVID, being the first quarter after COVID when the markets had opened. In addition to that, we had also spoken about the global uncertainty, persistence of inflation, and the prevailing uncertainties globally. All of this will ease off, and it will take time for that to happen, particularly in the informal sector. Consequently, we observe the mass and masstige segment in apparel continues to have muted growth. June has been better, and July is continuing in the same lines. Despite these challenges, we have delivered a resilient performance this quarter and is quite competitive. Let me talk about the Q1 performance and the way ahead. We have delivered sales growth of 4% with gross margin remaining flat and EBITDA of 58 crores against 68 crores last year during the same period. Our EBITDA decline can be attributed to two large factors. First, being that we have invested into new initiatives and margins were flat due to offers in mass and masstige brands during the season. On some of the other KPIs, our average transaction value grew by 8% this year versus the same period last year, with continued premiumization across the category and brands. This is the 13th consecutive quarter of growth in the average transaction value, and this shows that our customers are blessing us with higher wallet spends. Our average selling price grew by 5%, primarily due to our focus on premiumization across the categories. On non-apparels, we observed double-digit sales growth. A good example of the shift to premiumization is in the watches category, where the share of Titan watches above 15,000 rupees has grown from 11% to 23%. In the same space, our items per transaction, which is the third metric that we track, grew by 4%. Again, underlining the fact that our customers are putting more items into their basket when they come into our stores and online. Our customers and their preference for premium products has increased. The early start of end-of-season sale across the industry resulted into higher footfalls in malls, and we also saw the same. We did observe higher discounting to expedite inventory liquidation. Let me now move on to costs and share some of the key details on the operational costs. Our total costs have increased by 10%. We have been investing into new initiatives such as the footwear in private brand, launching ssbeauty.in, an exclusive website for our premium beauty products available in the SS Beauty stores. And in June, we introduced a new format which offers fashion for all in the name of Intune, which I will talk about a bit later. Without these new initiatives, our costs would have increased by a nominal 6 to 7%, which is largely inflation-led. We have always been cautious on spending and continue to monitor the costs, particularly during these tough times. With strong sales and tight control on costs, during the quarter we reported an EBITDA of 58 crores compared to an EBITDA of 68 crores in FY23 first quarter. As I said before, market conditions on apparel and the new initiatives led to the marginal decline in EBITDA, and we firmly believe we will recover this during the year, particularly in the second half of this financial year. During the quarter, we opened 6 beauty stores and 1 home stop store. We would have opened 2 to 3 department stores, but due to delay in getting regulatory approvals, the opening of these stores have been delayed. We should open 2 department stores in the next 2 to 4 weeks, which are fully fitted out and just waiting for the mall itself to open. As you observe, we have sustained improvement in all our KPIs for more than 10 quarters now. We follow the 3C framework, which is consistent growth, customer centricity, and capital allocation. I have talked on the growth part. I will cover customer centricity in our strategic pillar and capital allocation, including working capital, investment in new stores, and cash flow subsequently. From operations, I will now move on to the performance of each of our strategic pillars. Starting with First Citizen, which is our first strategic pillar. Our loyal customers continue to return back to shop with us, which is the pillar that's a firm foundation for our success. We firmly believe customer loyalty is important to retailers because it helps them to build a strong relationship with their customers and gives better insight through analytics of their behavior, preferences, and likes. We have created a culture in our company that customer is the core of everything, and providing a seamless shopping experience to them, delighting them with exceptional services, going the extra mile is our way to show that we care. Our First Citizen program creates an emotional connection between our customers and us, one in which our customers feel seen and heard. We cater to their needs, provide exclusive shopping experiences, and offer tailored promotions. We have the highest advocacy within retail in India, and we are proud of that. Our loyalty contribution is now at 80% in offline and 42% online. Our repeat sales and members shop grew at 11% and 3% respectively, driven through the Black Card tier and the Platinum tier. Our loyalty contribution at standalone beauty stores was at 71%, almost double. We had more than 150 customer engagement activities during the quarter across our stores, and these engagements resulted in twice value of sales with 26% higher average transaction value. Our loyalty points redemption sales generated 11% and 16% growth over the previous year. We also focused on our inactive base, and this generated an additional 4% of our revenue through specific campaigns. Our new enrollments have increased by over nearly 200,000. On our First Citizen Black Card contribution is now increased to 13% with consistent double the average transaction value of the normal customer and spends of more than 4 times that of a normal First Citizen member. Moving to the second strategic pillar of private brands. Our private brand sales largely remained flat due to the tough market conditions in apparel. During the quarter, we achieved 171 crores. Our private brand share has sustained at 14% for the quarter, and the share within apparel is at 21%. Indian wear outperformed, and our brand Hot Curry grew by 42%, and the occasion wear brand Kashish by 14%. The kids infant brand Carrot grew by 7%, which also saw an expansion of apparel range for newborn. The smart casual wear brand Fratini grew by 39% overall. Within the private brand portfolio, I would now like to talk about the new format that we have launched, Intune. This is a fashion for all format for the trendy college goer to the classically dressed young parent to the cute and energetic kid. Intune has something for everyone. This is a trial that we have launched, and we have opened 3 stores so far, 2 in Hyderabad and 1 in Dombivli. The early results extremely encouraging, and we are continuing a few more stores as a part of this trial, and we would have more details on it in the coming quarter. This category, we are primarily focusing on apparels across men's, women's and kid category, and our objective is to provide irresistible fashion at unmatched prices. With its 100% in-house assortment, Intune brings to the fore fresh quality fashion for the cool-spirited and shockingly accessible prices. Apart from ensuring differentiated fashion and experience for customers, active control of the value chain is integral to evolving a sustainable business model for this concept, which is one of the strengths of us as an organization. I'll now move on to beauty. Beauty is one of our fastest growing categories and contributed to 16.4% of our overall sales with 216 crores, an increase of 13%. Our unrelenting customer engagement activities such as makeovers in stores led to double-digit contribution to the beauty revenue. We have launched more than 80 SKUs across the beauty segment, taking the portfolio to 500 plus SKUs. We have also introduced virtual try-on and skin analyzer at SS Beauty Store, and this is one of the unique propositions from Shopperstop to its customers. Our SS Beauty stores are performing well, and we continue to expand our reach through standalone beauty stores. Apart from the 98 department stores where we offer beauty brands, we now have 89 boutique beauty stores which are standalone. Our beauty distribution business is progressing as per the plan. We are launching Armani, which is a flagship brand from L'Oreal International Division, and the perfume brands of Tumi and Banana Republic from the Park Fragrance Group in this quarter. The recently launched beauty distribution contributed 15 crores worth of sales and achieved a break-even at an EBITDA level. A total of 20 retailers have been onboarded online as offline, with 266 doors till date from where these brands are now retailed. Moving on to the next strategic pillar of omnichannel. Omnichannel retailing, which offers a seamless and consistent shopping experience across multiple channels, is rapidly gaining popularity. Customers expect a seamless experience as they move between physical and digital channels. At Shopperstop, we have one view of our customer through products being available in our stores and at the same time on shopperstop.com. Our online shopperstop.com had a good quarter and registered a growth of over 16%. We are aware that omnichannel retailing is a rapidly evolving landscape and we will need to stay ahead of the curve to meet the changing needs of their customers, and we are well geared to do that. From the strategic pillars, I will now move to capital expenditure, working capital, and cash flow. We have opened 31 department stores in the last 3 years. Our capex is circa 200 crores per annum, and it's primarily funded through internal accruals. In the quarter, we renovated 3 large department stores, 1 beauty store, and also 1 home stop. We also made investments in technology and other areas. For the quarter, including deposits, we spent 55 crores on capex. Due to external factors, as I mentioned before, the store's opening has been delayed, and we will be opening 2 stores in the next 2 to 4 weeks, with 3 more stores before the end of the quarter. We have 4 stores under fit out as we speak, and we are on track to open 12 large department stores and 15 beauty stores during the year. In addition to that, we are opening a brand new state-of-the-art large beauty format in Quest Mall in Calcutta at the end of Q3 or early Q4. This will be a 9,000 square feet beauty hall and will be the first of its kind in the country. Our inventory increase is led by beauty, partly due to the increase from SOR to outright and lower sales in the private brand apparel, which would get corrected in the coming months. Our investments in capital expenditure and increase in stocks will be augmenting the future growth. We are a net borrowing of 90 crores at the end of the quarter, and due to the shifting of the festive period from the end of Q2 to Q3, I expect the net borrowings to be in the range of between 100 to 120 crores at the end of the second quarter. We have both Pujo, Diwali and the second end of season sale in December, and post that I expect cash surplus in our business. I'm reasonably confident that we will end this year with cash surplus even after our planned investment of 200 crores in capex. Finally, looking at the outlook for the future, at Shopperstop, we continue to partner with brands and launch new brands, ensuring that our customers have something new each time they visit our stores. We are future ready in terms of product offering and customer experience. We continue our efforts towards collaborations with large global apparel and beauty brands, which helps us to offer new brands to our customers each time they visit us. On store launches, just to reiterate, we plan to have 12 department stores and 15 beauty store launches in FY24, which we are on track for. Fitment and renovations of existing stores will continue as planned. We are continuing our efforts to give premium experience to our customers across physical and online platforms. Our investment in SS Beauty and Global SS brands will continue. And last but not the least, we expect Q2 to have modest growth as there has been a shift of season from Q2 to Q3 this fiscal year, the shift in festive, which I mentioned just before. As I said in the past, for a vast economy of India, any slowness is temporary. We are confident the Indian economy will turn the corner, which is already happening in sectors like travel, hotel, FMCG, etc., and they are into the growth phase. We are buoyant and very confident that the apparel sector would have a higher growth in the subsequent quarters. With that, note of positivity, I end my speech and will answer questions that you may have. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Sameer Gupta from India Infoline. Please go ahead.
Hi, good morning, and thanks for taking my question. I have two. So firstly, on the department store addition, I recall that at the end of the third quarter, we had stated that we had 5 department stores under fit out. Now, fourth quarter, we saw 2 department store additions, none this quarter. So are we just being more measured on the demand environment in our store openings, or is there a real, procedural regulatory issues that we are facing? And in case of the latter, is this 12 department store addition guidance for the year, going to be very back-ended, and is there a risk of a spillover here?
Morning, Samir, and thanks for that question. It's an interesting and good one. If I get into a little bit more specific, the 2 stores which were supposed to open in this, what we had expected to open in this quarter are Guntur and Cochin, which originally we had started fit out and we were planning to have it opened in March. Both of these stores did not get their occupation certificate, and even as we speak, they've just got it in the last week. So as Guntur will open on the 10th of August, and Cochin is slated to open on the 19th of August, which is when the mall itself opens. So it was purely due to the occupancy certificate, without which obviously we can't open. Coming on to your second question in terms of the 12 department stores, we expect to have 5 stores opened within this quarter itself, and we should have a further 3 in the third quarter. So I don't expect it to be back-ended. Having said that, I keep my fingers crossed as I say it, because we are at the mercy of where in the case if it is a large mall, then the mall itself being ready, and B, the occupancy certificate and the other certifications that are required being obtained by the landlord or the mall developer, as it might be. The one thing which we won't do is to rush into opening a store purely for ticking the box and factoring in a store open. Because when that happens, all that we end up doing is having a store open too early with not enough customers coming in, and that just doesn't give a good experience to any of us. So internally we've put some guidelines as to how much of the mall has to be occupied before we open a store, and that's something which we will strictly monitor and follow.
Thanks, sir, for a very detailed answer. Second question is on the margin front. So we've done around a 4.6% margin if I look at on a gross sale level this quarter on a pre-Ind AS basis. Now, we are doing a lot of things. We are, opening a new beauty format, as you alluded to, in Kolkata. We are trialing a new format in Intune. So are we still guiding for a high single-digit margin in the medium term, or is that also at risk at this point in time?
So one is, I would just like to clarify that each of the investments that we are doing are in line with our strategy, focusing on our strategic pillars of the 2 that we specifically talked about, the beauty store as a part of our beauty pillar, and the new format Intune as a part of the private brand pillar. In terms of margin, the guideline that we had given earlier is what we continue to maintain. At an EBITDA level, at the quarter, we were at 5.3%, and the guidance of high single digit is what we continue to maintain. We don't see any significant dilution of margins with these new investments.
Just a clarification, sir. This 5.3% is on net sales, and I believe our guidance has always been on gross level. So just wanted that to be clarified.
You are absolutely right. Yes.
Okay, cool. Thank you, sir.
Thank you. We have the next question from the line of Nihal Mahesh Jham from Nuvama. Please go ahead.
Yes, thank you so much, and good morning to the management. So my first question would it be possible to share the footfalls for the offline stores, how that has been on a YOY basis? Looking for that number first.
Nihal, on footfalls, we have moved to a new system of measuring footfalls using cameras, which was installed in the fourth quarter, and now all of the stores have moved to that. So because of that, I just want to flag that it is two different systems which we are looking at. Last year was on a different system versus this year camera-based system, which is more advanced and AI-enabled. Having said that, in the first quarter, we had a total growth of 8% on footfalls in our stores.
If I understand, that number was around 17 million last year, so this quarter was around, say, 18.5 kind of a number.
No, it was 10.5 last year and 11.4 this year.
The offline customer entries?
That's right.
Okay, I'll take that separately. Then the other part is that as you started EOSS early, have you seen a significant improvement in the footfalls for the last 10 days of June and the ensuing 25 days of July, or that is also something that is still tracking on a moderate basis despite EOSS starting?
At the end of EOSS, normally when we get into the end of season sale, we do see a significant growth in footfall or increase in footfall, and that's something which we saw this time as well. In total, there was a growth of 11% in the month of June, and specifically during the last 2 weeks when we went into sale, it was significantly higher. I don't have the breakdown of that, but it was upwards of 20%.
That is helpful. So the second question was on the inventory part. You did highlight that in your effort to obviously reduce the inventory, there was EOSS which was preponed. And we did mention that maybe on the private label side, the traction is limited. As we stand today, is the inventory situation stable, or it is still a little on the higher side where we may have to say increase the EOSS days potentially or the percentage to normalize it before the festive comes in?
Hey Nihal, Karuna here. See, as of 30th June, we did have some higher inventory on private brands. We expect that to normalize in July, August, and the inventory should come down for private brands. Having said this, on beauty, the beauty growth has been quite good, and the inventory will be at these levels even in the coming quarters.
Got that. Final question was on Intune. Just to understand that in terms of, say, getting the backend in place and also the design system that is totally being worked on, and now incrementally we're just going to add stores based on how the response is, or that is also something we are still going to be putting in place, and it will be a gradual scale up for this brand even over the next 1 to 2 years?
Our plan, firstly, it is a separate team which has been set up for Intune, and it is operated entirely differently to Shopperstop because it is a different market and a different brand. It is in its pilot stage, and we intend to have 10 stores by the end of Q2, which is when we would have more results to share.
One last question. What would be the ASP for this brand, and I'll be done?
Sorry, Nihal, you are very fast.
I'm so sorry. I was asking what would be the ASP of Intune?
It is between 450 to 500.
Sure. Thank you so much. I wish you all the best.
Thank you.
Thank you. The next question is from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for the opportunity, sir. Just some clarification, you said 10 stores in Intune by the end of Q2?
Yes.
Okay. So my question is with regards to the absolute other expenditure for the quarter. So if you look at the BSE reported other expenditure number, that number is down by 3 to 4%. So just wanted to get a sense from your end, how should we look at this cost? Because, this has been coming down quarter by quarter on an absolute basis.
Gaurav, Karuna here, Gaurav. Your voice was not clear. Are you talking about other expenses in the gap numbers were declined by 4%?
Yes. So Karuna, if you see that was 152 crores odd in Q1 FY23, and now it is around 146 crores odd in Q1 FY24. So, on an absolute basis, it is down. So just wanted to get a sense, how should we model this going ahead?
Okay. See, what happened in FY23 was some of the lease rental payments, we've opened the store and some hiccups on signing the final agreement. So the AS 1116 got invoked in the second and third quarter, and that's the reason there was a higher lease rental expenditure. Whereas in this quarter, we ensured that all were accounted in AS 116. I'm sure you understand the AS 116 regulation. I mean, once the lease agreement is completed with the final term period, then the AS 116 taking of ROU asset and ROU liability starts. And that's one of the reasons. Other one is, of course, we are also monitoring all the expenses, and wherever it's possible, we are reducing the cost, Gaurav.
Sure. So simply put, should the amount that we are seeing, on an absolute basis, can that be extrapolated, or we might see some spike, as these store openings start coming up from Q2 onwards?
A bit difficult to say that right now, but very unlikely, because we would like to include the entire lease rentals in ROU asset and liability from the beginning of the lease term itself, and that's what we aspire for, because it gives a correct picture if somebody is referring the gap numbers.
Sure. And Karuna, next question is with regards to the top line growth. I mean, we do understand that the top line has been impacted largely due to this benign environment in the apparel space. But how do we, look this ahead? Because on a 4-year CAGR basis also, this number, hasn't really picked up over the last many quarters. So this has been in the range of around that 4% odd mark. So, despite the store addition, I mean, if you see the ASP increase was around 4%, and which is actually the top line growth for us. So do we see negative volumes here because the stores have also been added, that the additional square footage has also come up? So how should we look at this?
So overall, at a volume level, we were largely flat for the quarter, and as you rightly mentioned, apparel has been benign, and that led to a little bit of the slowdown. In the medium term, we expect the growth to come back, and we would expect high single digit or a low double digit growth, which is what we are aiming for, and that's what we would be expecting. Obviously, this would be a combination of like for like and the new store, and as the new stores get into full effect, that's when we see the impact of that.
Okay, sure, sir. Thank you. That's all from me.
Thank you. We have the next question from the line of Ankit Kedia from Phillip Capital. Please go ahead.
Sir, 2 questions from my side. First is on the ESOPs. There was a 3.5 crore ESOP expenses in the quarter. Could you just quantify for next 2 years what could be the ESOP expenses we should build in, and how much dilution would come in to the parent company?
Ankit, this year it should be in the range of 10 to 11 crores. Next year, see, as you are aware, we granted the scheme last year in July 2022, 22. And it always happens, the first year is higher and second year is lower, and it's more of the reverse of hockey stick approach. So this year I would expect to be between 10 and 11 crores. Next year it should be much lower than that, and year 4 would be a very low single digit number. Okay. When I say year 4, it will be FY26. That's one. I'm sorry, what's your second question, Ankit?
Sir, dilution?
It's overall, it should not exceed more than 1.8 or 1.9%. That's it, nothing more than that.
Over 4 years?
Over a period of 4 years for the entire scheme, you are right.
My second question is regarding the beauty distribution business. This quarter, we saw low teens top line. You had guided for, 175 to 200 crore revenue for this business for the year. So how should we build this at the back end for quarter 3, quarter 4? Are we on track to achieve that guidance, or, how should we monitor this business?
We were just ahead of budget in the first quarter, and the second quarter is progressing well. The launch of Armani has got pushed back by a month and was to launch in July, but it will happen in August. So to that extent, we are broadly in line with our plans. The two big factors which come into play is Armani is the largest player by large, and hence we specifically mentioned that. The second big kicker will be when NARS is launched, and we are planning to have the NARS launch in Q3 of this year. By design, it is back-ended, and we are on track as of now.
And sir, when you say, on the new investments, footwear private label, SS Beauty Online and Intune, how much, back-ended investments for all three should we build in our model, for this year and next year in these businesses? Because Intune will probably be loss-making for a couple of more years, given that you will have aggressive store expansion in year 1 and they will take at least 18 months to break even. Along with that, obviously, beauty B2B will also take time to break even or just be break even in this year. So, at least in the initial quarters, what should be the impact on EBITDA for these businesses? So
on footwear, the investment's already done, and we don't expect any further investment into that. The ssbeauty.in also, the investment on the build itself is over, and now it is about growing the business, and we intend to run it as an omni-channel business, hence we wouldn't expect it to be very large. On Intune, and again Intune, we expect it to be break-even from year 1 itself. So to that extent, we don't expect it to be a significant impact on the bottom line.
And so if I may ask one more question, could you just share the store economics for Intune? How are you looking at it from a gross margin to EBITDA margin, capex per store? That will be helpful for us to build a model.
It's a fair question, Ankit, but as I said, it's only 3 stores. We are extremely delighted with the results that we have seen, but at the same time, it's still early for us. The guidance which I gave in terms of how we expect the EBITDA is based on what we have budgeted, and we are ahead of that. I would like to take another quarter to have a bit more experience in terms of what we are seeing before we report. As you know, it needs to go through the full cycle of the season, including the end of season sale, etc. The results what we are seeing currently, the 3 stores, actually they are trading without any end of season sale. We actually launched them during the end of season sale at full price, and they are stacking up well compared to the rest of the market. So that's encouraging, but would like to give more details on it once we've had more stores open.
This is helpful, sir. All the best, and thank you.
Thank you.
Thanks, Ankit.
Thank you. We have the next question from the line of Varun Singh from ICICI Securities. Please go ahead.
Am I audible?
Yeah, you are.
Okay. Thank you very much for the opportunity, sir. 2 questions from my side. First, is when I look at the result, so one impression that I have is that our performance in private label has been much lower compared to the branded product. I mean, that is also, looking at the outperformance in the beauty and the accessories segment, that is quite appealing. But having said that, given 5% ASP and 8 to 9% retail expansion, looking at 98 stores, even though we have not added any stores, but looking at the number of stores in the base quarter, so 9% retail expansion, 5% ASP, 4% overall revenue growth, and flat revenue growth in private label. So, what I could understand is our branded business has performed better compared to private label. And given the general industry slowdown in apparel that we are facing, and as Venu has also highlighted, I would, as an analyst, expect private label to outperform the branded players given the lower ASP, etc. How should we, kind of understand this underperformance in private label despite the overall industry general slowdown? This is my first question.
So if I take that into two parts, first is within apparels, private brand and the national international brands that we have, their performance was on par. So they were very similar. The overall branded business is ahead, primarily led by the beauty and non-apparel growth. And as we said, the overall apparel business was benign in terms of the market itself, and the private brand has followed that trajectory. Within that, again, we had it was a couple of brands which pulled out the overall number. Indian wear was a star outlier and a star performer across both Hot Curry and Kashish. Similarly, in kids, the brand Carrot did extremely well. Within men's, Fratini did very well. The one area which was muted and challenging was Western wear. And in this category, specifically, Life as a brand was well behind the curve. So that's the one which we need to fix.
Understood, sir. But even, frankly, looking at only private label revenue growth, which is flat, and 9% retail expansion in the departmental store, and also, as you alluded, that the performance in apparel was similar for both branded and private label, assuming only apparel in the respective segment. Still, sir, don't you think this performance is still, much more subdued compared to what it should have been?
I agree. We had expected it to be better, and specifically April and May was challenging, and which pulled down the overall performance to be at par rather than ahead of the rest of the apparel categories. That's something which we are conscious of. We've seen revival in June, and we expect with the launch of the new season in August for this to come back.
Right. Sir, what I intended to ask, that is the problem structural or temporary or seasonal? If I can put it that way.
It's definitely a seasonal issue, and as I said, within Western wear, the product performance was slightly below par. The overall market also was low for Western wear, but we were hit probably a bit more on that. But it's more seasonal, and that's the beauty of private brand specifically, because as the season changes, you get in fresh merchandise, and it's about making sure that we clear the inventory that we have built up to be able to launch the new brands, which is what we are doing.
Got it. And sir, my second question is, now that, since you joined Shopperstop in November 2020, it has been more than 2 years that all the strategic interventions that you executed very, very rightfully in all different segments. If I understand correctly, whatever incremental store addition after you joined that we have done, that would now reflect almost maybe 25% new store in the total whatever departmental store that we have executed. On the beauty side of the business, we are doing quite decent, but on the departmental store side of the business, how much of the journey you think that you have already traveled, or like how happy you are with regards to the intervention that you have executed, given FY23 was a COVID-free year, and as a consequence, now going forward, I mean, the Intune side of the business, excitement, high growth, etc., I mean, that I understand. But on the departmental store, on the branded side of the business, you think more fine-tuning is required? Or like how, what is your candid assessment of what we have already done so far?
So if I take that into parts, we've opened 20 stores in the last 2.5 years. We have also optimized some stores, and the third thing is we've been renovating, and that's something which is still in progress. We still have about 17 stores which are old and need work, which we will do. What we are finding is that the new stores, their productivity is about 15% higher than the older concept stores. The capex is also optimized, which definitely helps from an overall return perspective. And in the stores that we have opened, what is appealing and we're getting good customer feedback is in terms of the design, the open facade, the fixtures being a lot more compact, and the lights being much more brighter. Going back to that first point on the total stores that we opened, I must also flag that as a part of our regular process, we also close stores. And we closed, I think, if I'm not mistaken, about 5 stores in the last 2 years. 14 in the last 3, but in the last 2 years specifically, it was around 5 stores.
Understood, sir. And on the branded side of the business, do you think any fine-tuning is required, or that's perfectly fine?
See, the branded side of the business is in very exciting times, because with the onset of a lot of D2C brands, it also gives us the opportunity to bring in some exciting brands into our stores, which is what we have been doing, and we'll continue to do that. And what we do is to make sure that we have a regular churn based on customer requirements, customer feedback, at the same time performance. And we would churn between 20 to 25% of the brands at the end of a quarter, and definitely at the end of the season, to make sure that each time the customer comes into a store, there are new brands that we are able to offer.
Got it, sir. That's it from my side. Thank you very much.
Thank you. The next question is from the line of Shalini Gupta from East India Securities. Please go ahead.
Good morning, sir. Just wanted to understand what has been the growth of the department stores without beauty, without your private brands. Just the department stores, what has been the growth?
Shalini, good morning. I think that, both private brand and beauty are an integral part of the department store. So, we don't look at it differently or separately, and I don't think we can do that in any form. What I can say is the department store format growth itself was slightly ahead of the total curve at 5%.
Okay. And sir, what has been the online sales growth?
Again, we don't separate out online and offline because of the fact that a number of customer journeys start offline and finish online, or vice versa, especially because we are in the premium segment. We sell products at high selling prices, and hence a number of customers would start the journey online but would finish it offline when they would come and specifically see the product. Like watches as an example, where they would want to feel the product, see the product. So it wouldn't be fair for us to separately report online, and that's what we don't do.
And sir, home stores, would you say how much sales were in this quarter?
So as you know, we have Kavindra Mishra, who's joined us as the CEO for HomeStop, apart from also being the Chief Commercial Officer for Shopperstop as a whole. And under his leadership, and with a new business head for home, we have started the revamping of our home format. We have opened 2 new stores of HomeStop, one in Dehradun and the second one in Select City, Saket, and also renovated about 4 stores within the Shopperstop ecosystem. And all of these stores are doing extremely well, and we are very happy with the performance. And based on that, we intend to continue the growth, continue the expansion for HomeStop as we go forward.
Okay. And sir, last question. The footfalls, I understand you give the number. The number that you give is basically the physical footfalls as well as the people coming to your website. But if you could just say what has been the physical footfall for you people?
Shalini, Venu clarified when Nihal asked that question. Last year was 10.5 million and this year is 11.4 million. And there is an increase of 8% on footfall purely in offline.
Right, sir. Thank you. Thank you so much.
Thanks, Shalini. Have a nice day.
Thank you. We have the next question from the line of Gaurav Gandhi from Glory Tail Capital Management. Please go ahead.
Yes. Hi, sir. Congratulations on the recent progress overall. Sir, I have a question with slight medium to long-term perspective. Sir, if you look at the market today, it has become so competitive in terms of, pricing, variety, store appeal, etc. The way these Zudio, Trends, H&M, Zara, Westside, Centro kind of stores coming now. The only factor, I think, which will keep the customer stick to or, will attract towards Shopperstop will be the fashion and the variety we keep with us. So how do we manage the style and the fashion and the variety we keep with us, and are we able to catch the pulse of the market, especially the young generations?
It's a very good point that you mentioned, Gaurav. I think you are right in terms of the product being at the heart of and making sure that we are having the latest trends. And if I take a step back, as Shopperstop, we are a house of brands. And what we offer is the opportunity for our customers to shop multiple categories under one roof. And within these categories, we bring in a curation of the best of each of these brands. And our buyers are tasked and are experts in looking at what is coming in, and based on that, bringing the latest trends into our stores with the national brands, as well as in the case of private brands, we also have designers who look forward in terms of what are the coming trends, and based on that, bring the latest design the latest products for them to be in the store, whether it is the color, the trend, the fabric, the silhouette, and indeed the overall segment of the lifestyle that is going to come in trend. Like leisure wear was the initial trend a year back, which moved to quads, it moved to Victorian dresses, and that's a shift which will keep happening, and it's our job to predict and bring that trend into our stores at the same time as the rest of the high street. So that's the first part. Over and above that, what I would add to what you said is, while product is absolutely at the heart of what we do and very important, it is also the experience that we offer in our stores and the loyalty that our customers have to us because of the exclusive benefits that they get being a First Citizen customer. As you know, our First Citizen program is the longest standing loyalty program in the country and definitely within retail. And we are blessed by the business that our customers give us because of the experience that they get in our stores and the benefits that they get because of the loyalty. So first is loyalty. The second is the experience itself in our store. And again, one thing which is unique within our stores is the personal shopper, and the personal shoppers have now upgraded to being personal stylists. And what they do is offer our customers help and advice in terms of what the latest trends are, how garments are paired, and how they can buy an entire outfit rather than just a single garment. And this is something that we train our personal stylists every season, and based on that, they are able to help and add value to our customers when they are shopping. And equally, the parallel to that, and an example which I mentioned in my speech as well, is makeovers that we do on beauty. I think it's well repeated that we did over 4.5 lakh makeovers last year. And in this quarter alone, we've done over 1.5 lakh makeovers. And what we find is that when we do these makeovers, again, as you know, it is something personal. It is where there is an engagement between the makeup artist and the customer. The customer is able to have effectively education, at the same time also try out new things while they are in the store, and in that process they are able to also they end up buying more from us as they go forward. And I think all of this, if I summarize it in a nutshell, and if we look at how are we doing, we measure ourselves on NPS, and this is something which we had put a pause on during COVID. We've now restarted, and we're delighted by the fact that our NPS scores, with the constant focus on it, has moved from 60 to 75, which I believe is one of the best in class in the whole industry.
Okay. Exactly, sir. I hope that our focus, we keep on that. And another question was, what do we do with the unsold inventory in the apparel category eventually?
So, Gaurav, more than hope, I'm confident that will happen. In terms of the unsold inventory, again, it's something which we deal with as the season runs out, and we try and clear that out during the end of season sale, which is what we are doing now. So by the end of this quarter, the large part of it should be clear.
All right, sir. Thank you very much for explaining everything in detail. Thank you.
Thank you. We have the next question from the line of Amit Sinha from HDFC AMC. Please go ahead.
Hi, sir. Good morning, and thanks for the opportunity. My question was on the apparel segment overall, and you have mentioned clearly this quarter we have seen some moderation in the segment. So just wanted some more color there. You also said that the issue is seasonal in nature, but if I do maths, the overall segment moderation, at least in the SSG side, is significant, and just wanted some more color that which sub-segment, Indian wear or Western wear, or if you can provide some color on the same. If what is the kind of trend if in the overall apparel segment X of private label which you are seeing?
Sure, Amit. I'll try and give a little bit more color as you asked for. Within the six sub-segments, Indian wear outperformed pretty much all of the brands that we have in our store and had a fantastically great season. So that was the one which did extremely well, followed by men's, and men's also grew over the previous year, same quarter, and kids was largely on track. Now, if I look at the category which did perform well, it's Western women's wear, and within Western women's wear, the casual denim brand was the one which had a muted overall growth, and the other one was sleepwear specifically. And I think again, sleepwear, if I go back during COVID, obviously this was one which had peaked and had done extremely well. And up against some of those strong comparatives, it did have a muted, or rather it didn't grow, if I'm being totally honest. So it's Western wear or Western women's wear, which was a bit of a pain point for us. And that's the one which we are correcting as we go into the new season.
Okay. And, so apart from the, last year, same quarter high pent-up demand, which kind of, on an optical basis, which kind of impacted this year's number, what are the other reasons, specifically when you say that this problem is seasonal in nature, just wanted to understand that part, sir. I mean, is there anything which was one-off during the quarter which impacted the demand, or is it, a typical, inflation-led moderation in the overall demand environment?
No, and there was nothing one-off in the quarter. It is broadly, we have been at par with the environment. Private brands was not immune to what the rest of the industry has experienced. And I think as the reason I say seasonal is because we obviously launch new ranges after the end of season sale, which is when we offer a completely new the latest trends that come in, and this time it will be around modern workwear, which is what we would be launching as we go into the new season, followed by the festive season, and we expect the demand to come back as we go into that period.
Okay, sir. And lastly, for the full year FY24, is there any targets or any aspiration we have for the apparel segment as a whole?
We do have internal targets, but that's not a guidance that I would like to give out here.
Understood, sir. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants in the conference, please limit your questions to one per participant. Should you have a follow-up question, please rejoin the queue. Thank you. We have the next question from the line of Tejas Shah from Spark Capital. Please go ahead.
Yeah, sir. So I have 4 questions. I'll just try to stitch them together. Your strategic pillar slide, which you have been quite consistent in sharing, value retailing or fast fashion was never kind of part of that plan. So how should we see Intune kind of in light of that slide? Second, what would be the peer set for Intune? And fast fashion has become a very crowded space. So how we believe that we'll have like a separate value proposition or right to win there? And lastly, we have seen that value retailing is a very supply chain intense format. So after what store count the format will demand investment on the back end in terms of warehousing or other capabilities?
Thanks for that, Tejas. As I said, it's early stages. It is a pilot which we are looking at. But if I answer your questions and how it links back to our strategy, Intune is a part of our private brand strategy because it is about controlling end-to-end from design to what we offer to our customer, everything being done in-house and apart from the manufacturing itself. And that's where it fits into it. In terms of value retail itself, the reasoning behind that is, if you look at the overall market in India, the largest segment of the market is in the tier 2, tier 3 and beyond. Along with a huge unorganized market. I mean, today organized retail is less than 30% in apparel and 70% is in the unorganized space. And the unorganized space is around 1.3 lakh crores. So what we have been seeing over the last 10 years is the move from unorganized to organized, and hence that segment is very, very large. The one thing I would specifically flag is Intune, while it is priced attractively, it is fashion for all, and that's the segment that it is into. And what it does is to offer the young customer, the young family, choice across all of the categories of men's, women's, and kids, with kids being something which we are specifically focused on, and that becomes a big factor. In terms of the supply chain, which is the other question that you did ask about, and having strength in that, we have warehouses across the north, south, east, and west, 4 DCs across the country, and our capacity is committed. And this is, our capacity is, we have planned, and we have that capacity already for the expansion that we have planned for this year. And it is flexible, and we do have the ability to expand that quite quickly. So this is not something which we would worry about. What we have, along with the space that is available, which can be quickly expanded, will definitely take us till FY25. So we will take that expansion as the need arises. So effectively the next 3 years is covered from that point of view. And the overall capex requirement for that,
we have already committed.
Is committed, and it's about 3 crores. So that's already done.
Perfect. Thanks for the detailed answer, sir.
Thank you. We have the next question from the line of Disha Seth from Analysts Share and Stock Broking Private Limited. Please go ahead.
Hello. Am I audible?
Yes, ma'am. Please proceed.
Yeah. Good morning, sir. So I just wanted to check what would be the like-to-like growth since we have expanded to so many stores.
Our like-for-like for the quarter was at 1%.
At 1%. Okay. And sir, the 5 new stores which we are going to expand in FY24, so most of them, all of them would be in Tier 2, Tier 3, or we plan to open in Tier 1?
It is a combination, but I would say that almost 75% of it would be in the Tier 2s. I wouldn't say 3, but Tier 2s predominantly, with a few in Tier 1. So we do have a store in Pune. There is a store in Hyderabad, which we have slated. But along with that, we do have stores in Guntur, Kochi, Allahabad, Imphal, etc.
And sir, what in your view, considering the second half is going to be better, would be the sales growth for coming 2 years? Because considering we have to adjust the price as cotton prices have come down, so it might impact our overall sales growth. We won't have more of price growth, we'll have volume growth. So in your view, what would be 2 years sales growth in?
We expect to have, overall, the price, as you rightly said, is something which on a product basis we are not increasing. The premiumization that is happening is more from a product mix point of view, and that is what is leading to the price increase rather than absolute price increase itself. So that's something which we are very conscious of. In terms of the growth for the future quarter, that is something which we don't give guidance going forward, and hence we wouldn't do that. What I would like to point out is that for the last 13 quarters now, we've had higher average, the transaction values or the overall bill values that customers buy from us has continuously grown, and that is because they are buying more products from us each time they come to us, and that is a focus and emphasis for us to continue growing that. So we
can expect, sir, around high single-digit growth for the coming 2 years.
Isha, we normally don't give any guidance.
Okay, no problem. And so in terms of margins, this time it was 5.3%. So with premiumization increasing every quarter, we expect it to improve going forward. And also on the other side, we are taking out our Intune model, which is, I believe, grow EBITDA margin, lower EBITDA margin. So how is the mix going to play going forward?
That's a good question, Disha. on premiumization, please understand it's a combination of both brands as well as private brands. On brands, whether it's the margins are fixed. So merely premiumization may not increase the gross margin significantly. Second, to answer your next question, with Intune, Intune's margins would be largely, as we said, it's still in the pilot stage. The gross margins would be more or less at the same gross margin of the company. So we don't expect to have a significant dilution because of Intune.
Good to know, sir. That's it from my side. Thank you.
Thanks, Isha. Have a nice day.
Thank you. We have the next question from the line of Jay Gandhi from HDFC Securities. Please go ahead.
Yeah, thank you for the opportunity. So I just wanted to clarify one, the guidance of high single digit on net revenue or gross revenue?
What difference it makes? Both gross and net are in tandem.
No, GAAP or non-GAAP, that's what I meant.
We give only the non-GAAP revenue growth, Jay.
Oh, no, fair enough. And so this is on rental bills. Now I was just looking at your rent expenses last year, FY23. It was about 416 crores. So that works out to about 88 rupees per square foot per month. Now, if I look at the 1Q number, which is about 119 crores, annualize it, and let's say, assign a certain growth rate that you're going to have, the rental bill is about 107 rupees per square foot. This is a 20% jump on a per square foot basis. So just wanted to ask you, is this is there some one-off here, or are rental bills overall in the retail space meaningfully increasing?
I am not sure from where you got this last year rental. Just clarify, are we referring...
Sure. The standalone...
No, just hold on. So last year, if you are referring the non-GAAP numbers, Jay, let me open the file. It's quite a significantly higher number. It may be anywhere between 580 to 600 crores last year. Just give me a second. I'll give you a minute. Yeah. So last year, this FY23, we had a rental income of rental expenses of 600 crores.
Okay, 600.
Yeah, 599. That's what if you have seen our last year Q4 investor presentation, we had presented a 600 crore total rental expenses. And this year, it would have a modest single-digit increase as compared to the last year. There is neither one-time impact last year, nor we expect anything this year.
Okay. No, fair enough. Also, sir, I just want to ask you from a philosophical point of view, which category kind of lends itself to sticky revenues? Is it apparel or non-apparel? Just want to understand the hook for the end consumer to walk into your store.
I think there are a number of categories which would lend itself to that. Beauty is definitely one where, because of makeover engagement experience, the stickiness tends to be higher because it's a category where it's a choice. It's a choice of color, product, and also a combination, because the makeup regime would be a combination of 3 or 4 products, and the order in which it is done, the way it is done, is quite important, and this is where our makeup artists make a big difference. So beauty definitely is one category where you do have that advantage of stickiness coming in. Apparel tends to be brand-led, and specifically, again, customers shop for brands, and as a house of brands, we give the choice of multiple brands under one roof, which is what our customers come to us for. Combined with our personal shopper, who are personal stylists and help customers make choices in terms of how to pair and bring out the latest looks when they buy. That's something which again gives us gives customers a reasons to come back to us.
Right. Well, thanks. I think I'm done. So thank you so much for this.
Thank you, Jay.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. We thank the members of the management On behalf of Shopperstop Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.